What's up everybody, Dan again, stocktrades.ca. Welcome back to the Stock Trades YouTube channel. If you're a new watcher to the channel, we focus strictly on Canadian stocks, not much else. But this week we're actually going to make a little bit of a change and we're going to focus on the top Canadian REITs, REITs, or real estate investment trusts, however you want to say it. This is a video that was very popular and demanded by a ton of watchers on this YouTube channel, so we finally decided to create it. So with that being said, let's dive right into it. The top Canadian real estate investment trusts are coming up next. So a few quick things before we get started. For one, we're having a huge sale over at Stock Trades Premium. We typically only do this 3 or 4 times a year. So if you ended up missing our 24-hour discount we gave away for hitting 5,000 YouTube subscribers, this is another perfect opportunity to get in. You can head down below to the description. There'll be a link there. Keep in mind the highest discounts are tiered, so there will be less of them. And I believe last time we ran one of these, we had our highest level discounts sell out in like 10 to 15 minutes. So if you want to take advantage of it, head down to the description. The link's there for you. And secondly, we are putting our comment contest back on this week. We didn't run one last week. So what we do is you just need to head down below, comment on what you believe are the best real estate investment trusts in Canada today. And what we'll do is we'll pick a random comment and that person will get a full custom report from us over at Stock Trades Premium. The key thing is though, you need to be subscribed to the channel and you want to hit that notification bell, because the time we announce the winners will be in next week's video. So with that being said, head down below if you want to join Stock Trades Premium at some crazy discounts. Head down below and comment on this video if you want a free custom report from us. And let's dive into the top real estate investment trusts, starting with a very popular company, RioCan. So why do so many Canadians and us like a company like RioCan? Well, first off, REITs have taken an absolute beating in 2020. And as a result, they have presented themselves with some pretty high yields right now. RioCan yields around 9.3%, and this is a distribution that the company said will not be cut. Now, what the company says and what is actually done are two different things. You have to take everything like that with a grain of salt. But the fact is, RioCan has maintained their dividend thus far and should be able to do so moving forward. If you had invested in the company at the start of 2020, a $10,000 investment would be under $6,000 right now. And they are lagging the recovery of the TSX by a significant margin. And the reason for this is the fact that RioCan is mostly a retail REIT. But the fact is that is changing. Diversification for RioCan came long before this pandemic. In fact, a couple years ago, the company sold off $2 billion in non-core assets, and their plans for that money was to build out a more residential heavy portfolio. As of right now, the company says they have 2,700 residential units that are completed and around 900 condos or townhomes that are currently in different stages of development. So the company is doing a very good job of taking its retail assets and transforming them into mixed-use assets that can be used for retail, commercial, and most importantly, residential properties. And the company does a lot of this in one of the hottest real estate markets in the country, the Greater Toronto Area. The company's flagship project, The Well, is located right in downtown Toronto. And when the project is done, it's expected to add around 1.1 million square feet of commercial space, around 500,000 square feet of retail space, and around 1,800 residential units. This is a very ambitious project being built in one of Canada's hottest markets. And the company, prior to COVID, actually had projects lined up that were expected to add around 28 million square feet to its overall portfolio. And most of these projects already had zoning approval. So whether or not they go through now, and as we'll see later on, the company has slashed its developmental projects right now. We'll look at that in the quarterly report. But if these end up going through, RioCan is lined up to add a significant amount of space to its overall real estate portfolio. And this is a company that is growing at a pretty fast clip right now. So we know the company is very ambitious in their growth, But the fact is, we buy these real estate investment trusts for the dividend. So how is the company doing in the height of this unprecedented pandemic? Let's take a look at their second quarter results to see. And as we would expect, they are pretty bad. There was a lot of industries that were hit pretty hard, and you'll be pretty hard pressed to find a company that produced solid second quarter results. RioCan posted a net loss of over $350 million. This is compared to the second quarter of 2019, where they had net income of $253 million. And as you can see throughout the 6 months of 2020, the company has an overall net loss of nearly $250 million compared to net income of nearly $450 million. This is a pretty significant swing, and as you can see, their FFO per unit, or their funds from operations per unit, has gone from 94 cents to 80 cents. And when you're looking at a REIT, the FFO is extremely important when analyzing the dividend. So the most important thing when it comes to being able to see if the company is going to continue to maintain its distribution is rent collection. As of July 28th, 2020, you can see that the company has collected just under 75% of the rents in full. 5.8% are eligible for government funding, and around 7.7% were deferred with payment schedules. So the company says they still need to collect around 6.4% of rent. And this is actually a pretty high number and was a lot higher than expected. So another very important concept in terms of the distribution being maintained is the FFO per unit. So for the second quarter, it was 35 cents. This is a decrease of 11 cents or 24% from the first quarter of 2020. And obviously this was due to the aforementioned $19.1 million pandemic-related provision. So COVID-19 is having a drastic effect on this company, and probably will for the foreseeable future. I mean, as the economy opens back up, people are going to start getting back to work. Businesses are going to start to be reopened. But the thing is, there's always the threat of a second wave looming. And as such, RioCan's overall stock price has severely underperformed the market. So you want to buy a high-yielding REIT. You want to make sure that distribution is going to be maintained. What do you want to look for? Well, you want to look for a company that is steadily trending upwards now as the economy is opening back up. And RioCan does fall under that category. And another thing we want to look at is the tenant mix of RioCan, or the tenant mix of an REIT in general. You don't want them too overexposed to a particular sector, a single sector, especially in light of a potential second shutdown if there is a second wave this winter. Most importantly, over 3/4 of RioCan's portfolio is necessity-based and service-orientated sectors. So around 16% allocated to the grocery, pharmacy, liquor. Restaurants, quick service restaurants are 12.5%. Furniture and home, 9.3%. I mean, RioCan has a very diverse commercial portfolio, which is ultimately going to help them provide consistent revenue and maintain that distribution. So overall, we really like RioCan, but they are one of the more risky REIT plays right now, primarily because they're overexposure to the commercial sector. They are diversifying into residential properties, but this does take time, and a second economic shutdown could be very bad for the company. As of right now, they yield, just under 9.3%, and their payout ratio in terms of 2019 financials was around 80% of funds from operations. This is when the company was running at a full clip. I mean, this payout ratio is expected to be higher in 2020. And although the company has a ton of liquidity, over $1 billion actually, it should be able to maintain this distribution unless it gets very bad again. So the next REIT we're going to talk about, and one that is relatively unknown. I mean, it has daily average volume of around 179,000. And when you compare that to a company like RioCan that has average volume of 2.1 million, this REIT is not traded very much. And that is Crombie REIT. They trade under the ticker CRR.UN. So why exactly do we like Crombie? It doesn't yield as much as a company like RioCan, and it's relatively undercovered. Well, the fact is, it yields so low because it hasn't taken as big of a hit due to COVID-19. And The primary reason for this is because of the allocation of its overall real estate portfolio. Crombie, a $10,000 investment at the start of the year, would have you sitting with around $8,300 right now. And as we stated before, with RioCan, it has you sitting at around $5,700. So Crombie's yield is only around 6.8% because its share price has held up admiringly well considering this pandemic. So let's have a look at Crombie's rent collected and see how bad it got for the company during COVID-19, during the peak of COVID-19. The company collected from April to June 90% of its retail and commercial rent. And if we remember RioCan, they were in the low 70% range during this time. And the total gross rent of this retail and commercial space for Crombie is 91%. So that means that 91% of their total rent collections come from this retail and commercial sector. So it is absolutely imperative that the company keeps up on collections in this area. And the primary reason for the high collections is because the bulk of their portfolio, 55% actually, comes from Safeway and Sobeys grocery stores. These are businesses that were thriving regardless of the economic situation, especially during COVID-19, and will probably continue to thrive moving forward. These are defensive stocks that see relatively little fluctuations in revenue, and even if a second wave were to come, they're not going to get shut down. They are an essential service. So as I mentioned, Crombie's overall portfolio contains a ton of companies in the defensive sector that should bode well regardless of what is happening in the economy. The company has 76% of its rent towards grocery and pharmacy anchored properties. As we move down, we can see more stable companies: Shoppers Drug Mart, the province of Nova Scotia, Dollarama, Government of Canada, CIBC, Bank of Nova Scotia. I mean, these are all companies that will more than likely continue to pay their rent. 68% to essential service tenants, and only 8% of their portfolio is towards small business tenants, who we would consider to be the highest risk. As you can see here, 25% secret expense. That is the government plan that they had to help small businesses pay rent. Less than 1% of their gross rent is on this. Deferrals, again, around 1%. And only around 4% of rent is unpaid. Now, that's not to say the company was immune from COVID-19. It still struggled. And if we look to its AFFO per unit, you can see that it dropped from around 25 cents to 18 cents in the second quarter of 2020. So if we look to their total payout ratio, in 2019 it was a very healthy 89% of adjusted funds from operations. But as we can see in the second quarter of 2020, it's jumped up to around 125%. So while this ratio is unsustainable, it's more than likely to continue going on a downward trend as we move forward and as the economy reopens. Now, Crombie is not as liquid as RioCan. They have around $406 million in cash. But this is more than likely a distribution that should be able to be maintained, as the company is going to collect a higher amount of rents moving forward. And even if the economy were to suffer again, they would probably still continue to collect a significant amount of their rent, as they went through this pandemic with a 90+% rent collection. Overall, Crombie is a lesser known play, but a more reliable play due to the fact that its portfolio contains a ton of exposure to defensive industries. As such, it's held up quite well during this pandemic and will more than likely continue to hold up. But the one issue with Crombie is the fact that whenever you get one single company, empire company, that holds this much of an overall portfolio, it can have a drastic effect if the company were to lose that client. This is one thing you always have to consider with a REIT that has a very heavy reliance on a single tenant. So that's pretty much it for the video. Just a quick overview of some REITs that you can consider adding to your portfolio today. I personally own physical real estate. I charge rent for it, so I've never really been that interested in purchasing REITs. I currently don't own any, but I do understand that they are crazy popular among Canadians. For one, because they provide a high distribution, and secondly, because it allows Canadians to gain exposure to the real estate sector, whether it be residential, commercial, industrial, without actually owning the property. But the one thing you really need to make sure, especially in the economic conditions we're in now, is that the distribution is safe and the tenant base that the REIT is composed of is able to pay their rent. So with RioCan, they're strongly diversifying away from a pure play commercial style REIT, but this is going to take time, and we can see that the company really struggled to collect rent during the height of the pandemic. Whereas Crombie, being a unknown play but a more defensive play, considering the fact that the bulk of their portfolio comes from things like pharmacies, grocery stores, all essential services, it managed to collect rent at a much higher rate than RioCan did during the pandemic. So as always, subscribe to the channel, comment on the video. What are your favorite REITs you're looking at right now? Next week we'll randomly select a winner and they will get a full custom report from us on a company of their choosing from Stock Trades Premium. It can be a small cap stock, it can be a blue chip stock, a Canadian REIT, anything you want. The only way you can tell if you've won though is to make sure you subscribe to the channel, hit that notification bell, because the only way we get a hold of the winner is by announcing them in our next video. Again, if you're looking for more great Canadian content, stay tuned and we'll be back next week.